You're listening to the Index Investing Show. This is America's only weekly program focused on the important stock and bond indexes and the financial products that track them.
And now presenting your host,
Ron DeLegge.
Coming up on today's program, Self-Diagnosis, we're going to help you identify and eliminate investment problems that may exist inside your retirement portfolio. Also coming up, we're going to give you a recap of what's going on in global financial markets, along with digging into some of your emails as well as calls. 844-305-7800 is the number. We're here. Give us your first name along with your city, along with ticker symbols, any stocks, mutual funds, ETFs you want to talk about. You want to talk about the worst week in equity performance since 2008? We can also do that. The big question, though, is how are you doing? Forget about the broader equity market. Forget about what the individual companies and components are doing. How are you doing? How is your investment portfolio performing? And that's what we're going to talk about on today's show. I'm going to help you do a self-diagnosis of identifying and eliminating investment problems. Of course, it begins first with identifying the problem areas, the landmines, the things that you probably missed. And whenever you have a market correction, as we have right now, usually that's when these problems become quite evident. Not in a rising market, which masquerades or camouflages those problems. So we're going to help you identify some of the areas that I have seen based upon my experience, based upon the $200 million in portfolio report cards that I've analyzed. That is going to be something I'm going to help you with. So we've got a lot to get into on today's program. We'll start with what the broad market indexes are doing. We look at this on a very big picture basis. We also look at it on a year-to-date basis, which means since the start of 2018 up until now. And when I say now, I'm referring to the market close of December 21st. So taking a look at the broad U.S. stock market, ticker symbol VTI is one of the ETFs that follows that area, now down about 8.8%. Now, that is something that we'll get into a little bit later in terms of the sector performance, what is happening at that level, so stay tuned for that. If we take a look at the total U.S. bond market, it's down a little over 0.5%. Bonds on a relative basis holding up much better than, of course, stocks. Global REITs, also known as real estate investment trusts, are down about 5.2%. Commodities as a group are down almost 12%. USCI tracks a basket of various commodities. We've seen a collapse in, of course, crude oil, but also weakness in terms of performance from some of those industrial metals. And also, interestingly, precious metals, particularly gold, in this drawdown of stocks. You take a look at the performance of gold. It's been very weak. That camp of Gold 5,000, the perma bulls in terms of gold, we haven't seen gold really pop. And it's kind of curious that hasn't happened. I'm wondering, you gold bugs, if you've got any insight on why gold has been such of a lackluster performer while stocks have sold off. It's certainly not anything like we saw in 2008. Also, in terms of other global markets, international stocks as a group are down about 16%. And emerging markets, VWO, down about the same. So that's the year-to-date performance. Now, if we look at the performance from the peak in 2018, we see many indexes down 20% or more. The NASDAQ, for example, has declined more than 20% from its August 29th peak, and by definition is in a bear market. So that's what you've been hearing in terms of the media coverage, bear market, bear market, bear market. But the question is, again, and I want to focus on this, is you. We want to help you diagnose your own investment problems so that you can eliminate them. And certainly right now is a good time to be looking at doing this. 844-305-7800 is the number. We're here. You're listening to the Index Investing Show. Some of the things on the Twitter feed, I've been very active on Twitter this past week, and I encourage you to follow us at Index Show. I've been talking about many, many things. Of course, one of the big pieces of news was the Federal Reserve raising interest rates once again. And, of course, that bothering in a big way the president. And I had this to say, this was an article from Bloomberg saying that Trump was discussing firing the Fed Chairman Powell after the latest hike in interest rates. And my comment on that was, well, there's a 100% chance La Prez would nominate Alan Greenscum. Can you imagine that? Bringing Alan Greenscum back into the Federal Reserve. Wouldn't that be delightful? Also on the Twitter feed, an interesting chart that I want to talk about. Actually, it's a table, and it's in the just released January issue of ETF Guide Premium. I want to get into this a little bit later because it's a very relevant table that looks at stock performance on a quarterly basis, looking at it ahead in the future after we've had a drawdown or decline of at least 10% or more in the S&P 500. So the question is, what does the performance look like in stocks in the quarters ahead? And so I want to share with you some historical data, which I know you'll be interested in knowing, because we're always constantly curious about what the future holds, right? We want to know, well, what's coming? And so I think it's obviously history is our only point of reference. So this particular table I'm going to get into and share it with you. Also, in other news, the Securities Exchange Commission has charged Wealthfront and a second robo-advisor with false disclosures in the agency's first enforcement action against digital advisors. My comment on that is this. Ethical lapses of this magnitude were not supposed to ever happen in the utopian world of robo-advisors. Robo-advisors, as most of our listeners should know, at least the long-time listeners, I have been a critic of the robo-advisor movement from day one. I think that they're selling a farce. I know that people that have embraced this movement, this depersonalization of investment advice, I don't think that's something we should be celebrating. I think it's dangerous. I think it's a devolutionary trend. And I think a lot of people are going to get hurt, especially in difficult climates like we're facing right now in stocks. And so these so-called advisors, these algorithms, that's really what they are. They're not robo-advisors. They're just algorithms. And algorithms, this may be news to some of you, especially those of you that are tech heavy or tech focused people. Nothing against algorithms, but the problem with algorithms is that they're imperfect. And the imperfect algorithm sold to the investing public by these robo-advisors is already nuclear bombing a lot of capital. And I see corporate liquidations ahead for these robos. See, the problem with algos is they're not perfect. The idea that algorithms are disciplined and are not flawed will probably go down as a major blunder of this generation. Perfect algorithms, like healthy smoking and harmless explosives, simply aren't possible. You know why? Because imperfect humans are the programmers. You can't have an imperfect human program a perfect algorithm. I'm Ron DeLegge. Coming up next, Self-Diagnosing Your Investment Problems.
The Index Investing Show with Ron DeLegge.
You're listening to the Index Investing Show with Ron DeLegge. Go to indexshow.com to enroll in Ron's online classes for investors. Learn how to grow and protect your money.
On last week's program, we had some trivia. The question was, how much did the S&P 500 fall during the last bear market? That was 2008. And we did not have anybody respond with the correct answer. The correct answer was 38%. So there you go. There's your stock market history. Those of you wondering what that trivia question was. 844-305-7800 is the number. We're here. You're listening to the Index Investing Show. This is a live program. We talk about the birds and the bees of successful investing every week at this same hour. If you'd like to text the program, you can do that on Twitter. At Index Show is where you find me. You can also tweet the program. Email the program, ron@indexshow.com. And, of course, you can check out our website, indexshow.com. When you go there, you'll see our investment philosophy listed. It's really a manifesto of what I stand for and the philosophy of this show. I've said it so many times before in the past, but I'll say it again. My three-word investment philosophy is build, grow, and protect. And I've been saying that for quite a long time, and a lot of you have been focusing on building a portfolio and trying to grow it. Not so many of you have been trying to focus on protecting that portfolio. And in this kind of environment and climate, it's very important to do that. Now, some of the programs that we've aired, and I just want to share with you, because this is one of the few podcasts, this is one of the few radio broadcasts and programs out there that has been preparing you for this moment. Just listen to some of the titles and topics we've talked about over the past year. For example, these are all available, by the way, at our website. You can listen to them on demand, indexshow.com. You can also listen to them at iTunes as well as YouTube. Just search under the Index Investing Show. But this is some of the titles and topics we've talked about in terms of our episodes and programs. 4 battle-proven trading strategies. Diffusing single stock risk. Does your retirement portfolio have an adequate cushion? Are you gambling or are you investing? What's your bear market plan? Is it time to sell? Adopting the psychology of investing legends. Rescuing retirement late savers from doom. How to make profitable decisions when stocks fall. These are just some of the episodes, the titles of things that we've talked about on this program over the past year. In other words, we've been preparing you for this moment. Now is your time to shine. Or you could be like the rest of the world and crater. Wasn't it the great Rudyard Kipling, right? The great writer who said, if you can keep your head when all about you are losing theirs and blaming it on you, if you can trust yourself when all men doubt you, but make an allowance for their doubting too, if you can wait and not be tired of waiting or being lied about, don't deal in lies, or being hated, don't give way to hating, and yet don't look too good, nor talk too wise. If you can dream and not make dreams your master, if you can think and not make thoughts your aim, if you can meet with triumph and disaster and treat those two impostors just the same, if you can bear to hear the truth you've spoken, twisted by knaves to make a trap for fools, or watch the things you gave your life to broken, and stoop and build upon with worn-out tools. Yours is the earth and everything that's in it, and which is more, you'll be a man, my son. We can also say you'll be a woman, my daughter. And that's words of wisdom from Rudyard Kipling, the great writer. If you can keep your head when all about you are losing theirs, and right now they're losing theirs. Some of the other things on our Twitter feed at Index Show, I had a conversation with our colleague Rick Ferry, great guy, he's an author, and he had a lot of things to say this past week. One of the things he said was that people should stay the course. Stay the course. My comment on that was, individuals with the wrong asset mix should not stay the course. Unfortunately, that's probably most folks. So telling people just to stay the course, I think, is the wrong advice. That's the typical conventional wisdom advice. Stay the course. Don't do anything. That's wrong. Individuals with the wrong asset mix should not stay the course. And by the way, that describes the vast majority. The vast majority have the wrong asset mix. So they should not stay the course. What's the secret? Well, it's on the Twitter feed. At Index Show, you can see that conversation with Rick. I gave a three-steps recommendation of what those with the wrong asset mix should do before just staying the course blindly, right? The prudent investor does not blindly stay the course, right? They make changes. They make adjustments. They recognize that if there's weaknesses, they need to be removed. And that's what we're going to talk about on today's program, Self-Diagnosis, helping you identify and eliminating problems inside your investment portfolio. So what's the first area? Well, the first thing that I see, and I don't mention it enough, shame on me, I should, but one of the first signs of problems with your portfolio is performance that is worse versus the broader indexes. That is the first sign that your portfolio has problems. And, you know, we talk about this on the show. We give you a recap of what's happening in terms of, the ETFs following the broad-based indexes. But what I don't mention enough, and I need to start mentioning it, is that most people, unfortunately, most Wall Street money managers, most professionals, consistently underperform the indexes. So what does that mean? Well, that means that those numbers that you're hearing that I give you, for example, when we say the total U.S. stock market, for example, is down about 9% since the start of 2018, you need to keep in mind that that's just the broad market. The vast majority perform worse than the broad market. So that's just a benchmark. That's just a yardstick of what's going on in the broader market. Most people perform worse. And so if that describes your investment portfolio, we just diagnosed it. You got to look at the performance of your portfolio. This is one of the things I do with the portfolio report card service that I offer. You can go to portfolioreportcard.com, but look at the performance of your investments relative to the broader indexes. For example, ticker symbol SCHB is a broad yardstick of U.S. stocks. How is your portfolio doing relative to that? And that will give you a relatively decent indicator of whether your portfolio has significant problems or not. So that's the first tip that I've got for self-diagnosing your investment portfolio. I've got other tips, other things that you should be aware of, so stay tuned for that. 844-305-7800 is the number. Coming up next, we're going to get into some emails. I got an email about self-storage stocks and whether those perform better than regular stocks. Also got a question about commodity exchange traded funds. This is from a listener in Slovakia. So we're going to get into all of that. 844-305-7800 is the number. We're here. This is the Index Investing Show, and a lot to get into on today's program. Self-diagnosis, very important, identifying and eliminating investment problems that exist. Also, tidbits from the just released January issue of ETF Guide Premium. People with the wrong asset mix should not stay the course. That and much more. I'll be right back.
The Index Investing Show with Ron DeLegge.
The investment world is full of complex and expensive products. At Sector Spiders, we recognize the need for lower costs, more clarity, and greater focus. So we wrote a new chapter for today's investors. Sector Spider ETFs divide the S&P 500 into 10 distinct sectors. You can see exactly what you're investing in with full transparency. Each sector has the diversification of a mutual fund, the flexibility to tailor your investment strategy, the all-day tradability of a stock, and the tracking of an index. Sector Spider ETFs can be used to customize your portfolio allocations, overweight or underweight your sector exposure, and minimize single stock risk. Now it's time to turn the page to a clearer, more focused approach. Sector Spider ETFs, the next chapter in investing. Before investing, consider the fund's investment objectives, risks, charges, and expenses. Go to sectorspiders.com for a prospectus containing this information. Read it carefully. Visit us at sectorspiders.com.
You're listening to the Index Investing Show with Ron DeLegge. Go to indexshow.com to enroll in Ron's online classes for investors. Learn how to grow and protect your money.
All right, welcome back from the break. 844-305-7800 is the number. At Index Show is our Twitter handle. How is your portfolio? How is your retirement plan done here in the fourth quarter? It's been a very difficult climate for equity investors. Really, if we take a look at the global equity map, which is in the January issue of ETF Guide Premium, it was just released last week. And what you'll see is red, red, red throughout the globe. All regions are in the red. Now, if we compare that to last month, we had two areas that were still positive. It was the U.S. and Brazil. But those two areas have now turned negative. Most of the performance, if we look at it from a year-to-date basis, in other words, for all of 2018, not just from the peak, but if we look at the performance for all of 2018, most areas are suffering double-digit losses. Some of the worst performing countries continue to be those emerging market countries like China. China is down about 20% so far this year. Of course, the A shares have taken it even harder. But you've got other developed markets. Of course, China's an emerging market, but you've got other markets that are developed economies like Japan, as well as Canada, down 15 to 19%. Australia down about 16%. So the trend in terms of equity performance, at least in the short run, is down. Now, this has been good for some of those inverse performing funds. We've talked about them so many times. Right now, there's a bull market in bear market ETFs. What is a bear market ETF? Well, it's an inverse ETF. It's designed to go up in value when the underlying assets go down. And we're not going to talk about it on today's show, but I do have an online class that I have just released that is available at indexshow.com. And the title of that class is Profit During Crashing Markets, a step-by-step guide. Everything you need to know about bear markets and a specific tutorial taking you through how to prepare your portfolio, how to play offense, how to play defense. It was the great legendary investor Sir John Templeton that said, for those properly prepared, the bear market is not only a calamity, but it's an opportunity. And that course will help you to prepare for the opportunity. And you can go again to indexshow.com, enroll there, and learn more about all the ticker symbols. We've talked about them this past year quite extensively. Ticker symbol CHAD, which aims for 100% daily opposite performance to Chinese stocks. That's been a great performer. Of course, technology shares have been declining, and TECS is the ticker symbol of the Direction ETF that aims for triple daily opposite performance to technology stocks. And TECS has really been a hot performer, up almost 50% over the past several months. TECS, that's been a great performer. And there's many, many others, which I might have time to mention one or two more later. Now, in terms of broader sector performance, if we just take a look at the S&P 500 industry sectors, and I like to do this because it really tells us what's going on underneath the hood. And if we take a look at some of the industry sectors since the start of 2018 that have done well, healthcare stocks, ticker symbol XLV, V like Victor, again, XLV, ahead by 1.5%, still holding on to a gain. REITs, that's the real estate sector, XLRE, down about 1.8%. That sector is one of the other leaders in terms of performance. And XLU, which is atop all sector performers, that's utility sector, XLU, ahead by 5.6%, that being a sign of very defensive nature of how the mentality, how the market mood, the sentiment has shifted from a offense to defense. Previously, we had sectors like technology leading, and now we're seeing more defensive sectors like utilities, real estate, as well as staples continue to hold up better than these other sectors. XLP, by the way, is staples. Those are companies like Procter & Gamble, Colgate, and so forth. So that's what's going on in terms of industry sector performance. Tech on a year-to-date basis is down just about 6%, but as I mentioned earlier, another barometer of tech performance is the NASDAQ Composite, and that, since its highs in 2018, has fallen more than 20%. So technically, it is in a bear market. Now, one thing to remember is we will see a bounce. We will see a rally. One of the things people sometimes forget is that bear markets are not all down, down, down. You will have very volatile trading. And in fact, this particular sell-off, if we compare it to previous sell-offs, it's actually been quite orderly when you think about it. It has not had, for example, any shutdowns. We have not had any circuit breakers triggered where the markets shut down and everybody goes home and we come back tomorrow and start all over again. We haven't had that. It's been a very orderly decline from that perspective. So that's one thing that we've seen. The other thing, too, is that this particular sell-off has happened in the holiday season, and I think a lot of people have been traveling. A lot of people have not yet even begun to get their year-end statements and look at them, and I think a lot of people are going to be shocked when they do. And so when that happens, I think we could see another wave of selling. Now, what are some of the other things that can help you self-diagnose problems or potential pitfalls inside your investment portfolio? We already gave you one earlier, investment performance that's worse than the broader market. Here's another symptom of an investment problem. My portfolio costs too much. Now, this is not something we typically think about. The first thing we think about, especially in a market that's going down, we don't think about what the cost of the investments are. But it certainly is something that we need to think about at all times. In good markets, bad markets, what is the actual cost of your investment portfolio? How much are you paying to have your money managed? And if markets are going down and you're paying all these fees, that means you're performing even worse because you have to add on the fees plus the negative returns, and it compounds. Investment cost compounds. And so what is the benchmark? What is the yardstick of investment cost? Well, I use index ETFs. That is the benchmark of what investment portfolios should cost. Now, if you have the services of an investment advisor that you're paying, then there should be obviously a fee for that that's layered on top of that. But the point here is that the fees should be reasonable. The fees should be fair. You can also negotiate fees with your advisor, and you can say, listen, this is what you're quoting me, but this is what I want to pay. So these are some of the things that you need to think about. But investment portfolios that cost more than what index ETFs charge, that's clearly a problem. And you need to self-diagnose that. You need to look at that portfolio that you've got, whether it's a retirement portfolio or 401k, an IRA, whatever. look at the cost of the investment portfolio. Begin with the funds that you own. What are the fees that are being charged? And then begin to look at that. This, by the way, is something that I automatically do in the Portfolio Report Card service, which is free. It's available to you. But we've got to bring down your investment costs if you're going to get ahead. I'm Ron DeLegge. This is the Index Investing Show. I'll be right back.
The Index Investing Show with Ron DeLegge.
Have an investing question for Ron? Call 844-305-7800 or send your questions to @IndexShow on Twitter.
All right, welcome back from the break. We've got time to get into some of your emails. Dear Ron, I read somewhere that self-storage stocks consistently beat the S&P 500. The urge to hoard is irresistible. What do you think of public storage or self-storage stocks? Is there any ETF that tracks that? Signed, Robert in Murrieta, California. Robert, we appreciate the email. And taking a look at this particular area, you know, the fast answer to your question is there are no specific ETFs that segregate just public storage stocks. So there is nothing out there. Now, you do have an ETF called the Pacer Benchmark Industrial Real Estate ETF, ticker symbol INDS, which does have exposure to some of these storage companies, but it also has exposure to office properties and other types of industrial properties. So it's not pure exposure to what you're looking for, in this case, real estate storage stocks. INDS only has about $2.4 million in assets, so it's got very low amount of interest from investors. Trading volume is very depressed, so I would not say that would be a good way to play that particular theme. The other option you have, Robert, is to go with something like XLRE, which is a broader real estate ETF. Of course, XLRE owns just the real estate companies within the S&P 500, but you're going to have in that basket what you're looking for. You're going to have companies that are involved in storage, real estate storage, public storage. And so I think that would be a good place to start. And also you're going to have very low expenses and a pretty decent yield. So check out ticker symbol XLRE. Got another email here from a listener in Slovakia. This is Martin. Thank you, Ron, for a great show. I listened to your episode about commodities ETFs, and you compared ticker symbol USCI and DBC from Power Shares, USCI, of course, being from USCF. I see that Power Shares or Invesco also has ticker symbol PDBC. Can you please explain the difference between these funds? Thank you very much. That was from Martin in Slovakia. Thank you, Martin, from listening all the way from Slovakia. And in answer to your question, these three funds all track, of course, commodities, but they do it very differently. Now, I would say DBC is the most purist in terms of just straight index, non-active commodities, hands-on exposure, whereas PDBC and USCI are a little bit more active in how they're weighting commodity futures by whether they're using momentum or yield or roll of those futures contracts. They're using a little bit more of an active approach. So that's the thing that you need to remember. You need to ask yourself, well, what am I really looking for in my portfolio? Do I want more of a pure index exposure type of approach, which would be DBC, or do I want a little bit more of an active approach, which is what USCI and PDBC take? And if we just take a look at the 3-year performance of these funds, It's the index approach, the pure index approach, non-active, that has done much better. DBC has gained 11.5% over the past 3 years, while the other two funds, USCI and PDBC, have declined between 6 to almost 10% in value. So that's just a snapshot view, but that would hopefully be a good place to start, and hopefully that'll help you with the correct selection and choice for commodities exposure. Thank you very much, Martin, for your email. If you'd like to send me a question or comment, you could do that, ron@indexshow.com. That's my email address. You can also follow me on Twitter @indexshow. And, of course, you can go to our website, indexshow.com, and listen to all the archives of our past programs, along with enrolling in my online classes. I encourage you to do that. Now, we've been talking about self-diagnosing your investment problems, areas that may be affecting, in a negative way, your investment portfolio. We talked about performance that's worse than the broader market. That's a sign that you've got a problem. Also, elevated investment cost is another sign that your portfolio has problem. How about this one? My portfolio has no margin of safety. In other words, you've got no cushion, or your cushion is not adequate. It's not big enough. That could be certainly a problem. And that kind of leads into the other self-diagnosis. Is my portfolio too risky, right? How do we know the portfolio is too risky? Well, you can kind of look at that other related problem of performance. All these problems, by the way, are interrelated. They're somehow like a maze, like a circuit board. All these wires are connected. So with regard to risk, how do we know that the portfolio's too risky? Well, it's too risky because it doesn't match your risk tolerance, your risk capacity, right? And usually we don't find that out until the market starts to decline. Then we realize, oh my gosh, I was taking way more risk than I thought. And so this is another thing that you're self-diagnosing. You're identifying that problem. Now, the next step, which is just as important, is to eliminate or remove that problem by taking action. So identification, self-diagnosis is only step one. Step two is to eliminate the problem after it's been identified. Here's another self-diagnosis problem. My portfolio is built on the wrong foundation. That's very important. What's the right foundation? Does anybody know? The right foundation should be low cost, broadly diversified index ETFs that touch the major asset classes. That's your foundation. And it's a strong foundation. That foundation right there will outperform the vast majority of stock pickers, the vast majority of traders, and the vast majority of professional money managers and financial advisors. That's your core. That's your foundation. And like a building, like a structure that's in a storm, it will not survive the storm if it's not built on a solid foundation. It's the same with your investment portfolio. So these are some of the things that we're trying to help you to identify and to diagnose your investment portfolio. Find those problem areas so that you can eliminate them. This, by the way, is also an online class that I have that I encourage you to enroll in called Investing, How to Fix Hidden Flaws Inside Your Portfolio. And you can go to indexshow.com and enroll in that class. It's there right along my other classes. We told you earlier about the Profit During Crashing Markets, a step-by-step guide. That particular class is also available. Now, earlier I told you about the that table that looked at the S&P 500's future performance after it suffered a 10% decline or more. And did you know that there were only 4 years that had negative performance in the following quarter? That was in 1957, 1973, 2002, and 2008. All the rest of the quarters, future quarters, after the S&P 500 suffered a 10% decline, all of the other quarters, with the exception of those 4 years, were positive. So keep that in mind. I don't have time to really talk about this, the meaning of this extensively right now. I'll get into this probably next week, and we'll discuss it a little bit more extensively. But just keep this in mind, that when you've had a really bad quarter like we've had here in the fourth quarter of 2018, at least the statistics show that the likelihood of a positive quarter, the next quarter, seems to be rather high. Well, that does it for another episode of the Index Investing Show. At Index Shows, where you find me on Twitter. And until we meet again, may the market indexes be with you.
The opinions expressed in this broadcast are not necessarily that of our advertisers, sponsors, or broadcast partners. The discussion of investing is general and should not be construed as investment advice or an offer to buy or sell securities. Listeners are responsible for their own investment decisions and results. Before investing in mutual funds or ETFs, always consult a prospectus for risk, charges, expenses, and other information. Read the prospectus carefully before investing. Past performance is not indicative of future results. No reproduction or dissemination of the Index Investing Show is permitted without the expressed written consent of its producers.